Hey everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Investing Podcast. I'm Phil Wong. With me, as always, is Brad Price, and joining us again is Kim Nguyen. Thanks for joining us again, Kim.
No worries. Thanks for having me. With the new qualifying rules that came into play is before, what would happen is you would need to have enough income to support a mortgage with an interest rate of 4.79%, or the actual interest rate you're going to get from the lender plus 2%. Usually 4.79 is the rate that they default to. Now the changes is that the 479 has increased to 5.25%. So with this new rule change, it shaves approximately 4 to 5% of your actual purchase power. Some clients who are just on the cusp, like they're basically out of the cusp now. They either
Mhm.
have to lower the home that they want to buy, or just not buy at all. What we've been seeing now is a lot of different strategies to kind of maneuver around that. New builds have skyrocketed in prices. With the skyrocketing prices, there comes a pro and a con to it, right? Obviously, the con is yes, it's gonna, cost you more, but what if you already had a contract that was made already? In the mortgage realm, in order to get a 30-year amortization, you need to do a down payment of 20%.
There's no minimum term for these private lenders then.
No, there isn't. There's some that will do um, fully open. Don't just go out to a private lender and buy any home. You have to still run the numbers. There's still criteria that you have to work with, because once you get the mortgage with a private lender, yes, they don't really have any criterias, any rules surrounding that. But the moment that you jump and move it over to a regular lender, there's the TDS rules that come into play, like the GDS, and also your credit as well. Another route that we've seen was, maybe you need to go to the B lenders for maybe a shorter period, because keep in mind, like the moment I say alternative lending or B lending, a lot of people freak out and they think you're handcuffed for years. But again, you want to think of it almost like a band-aid strategy where, it's just very temporary. You could do something where it's only maybe 1 year term, and then after the 1 year, as long as your income has gone up, maybe at that time point you now qualify with a regular bank because your income's back to normal again. And at that point, we can just move you out of the B lender to the A lender. You don't want to just jump into a private lender just because. You need to have a proper execution plan. You got to have that exit strategy, because private lending isn't cheap. It really isn't. And again, usually rates, depending on if it's a deal where we're utilizing the equity in the home to get financing, in most of those cases, your interest rates will be in the double digit, right? So keep that in mind, double digits. While yes, it's interest only payments. So whatever your loan amount times it by the interest rate, that's what you're paying. Like it's interest that's compounded daily, but it's hefty though. It can be very, very high. And that's why, again, you have to be able to execute it properly. Whenever you're looking to go into private lending, I never like to see my clients in there longer than a month or 2 months, right? Especially if we're utilizing this type of strategy, because at that point, you're burning so much money. Like it's a high interest rate. You're buying a home with a credit card at that point, right? It's only meant to be, kind of like a bridge. So that way, once the title is transferred, you've got that built in equity and you know that equity is there, you jump right out of there.
All right.
And there's fees up front as well too. So keep that in mind, right? Most private lenders, they will charge upfront fees, and those fees could be anywhere between 2 to 3%. Now, some of them can roll it into the mortgage, but again, most of them will ask for that upfront too. So just make sure you set aside that money as well. Right now it is tougher to qualify, right? It's the interest rate is higher to qualify. So a couple ways to offset that is, if you really really want to buy the home, sometimes you have to cough up with a higher down payment, right? And right now, if you've got your savings, you're depleting it towards a down payment, where else are you going to get this money from? And where most clients are, especially in the millennial side, they're going towards their grandparents, or even just parents in general. And what their parents are doing is, because they own a home, like most cases, they own their own home, and there's a lot of money just trapped into the home that they're living in. What they're looking into now is something called a reverse mortgage. And what a reverse mortgage is it's based on age. So usually, we call it a senior's mortgage, right? Because you have to be at a certain age to tap into this. And the older you actually get, the more money you can take out. And the way that it works is, the money that you take out, the reason why they call it a reverse mortgage is, you, the borrower, you don't pay anything. Okay. You don't pay anything until the home is sold or until you pass away. And usually, when you pass away or when you sell the home or whatever the case is, at that time, the accrued interest is when you would pay that. So, for an example that I like to use is if you've got a client here who's got like a free and clear home, usually for a reverse mortgage, depending on your age, roughly they will give you about 50% loan to value. So if your home is worth, let's say 500,000, the reverse mortgage lender will give you 250,000. That money is literally just deposited to you as a lump sum. And what we're finding is parents or grandparents are actually taking that money to help their kids. They're using that because they're not paying any interest on it right away. There's no monthly payment, nothing. They don't pay anything until they sell the home or pass away. And they're taking that 250 and they're saying, you know what, kids, you need to buy a home. You need to get your foot into this market because it's crazy. Take this money and use that as a down payment. It's a very unique tool that many are utilizing now.
What's the interest rate of these reverse mortgages typically?
Yeah, so it works the same way as a mortgage where there's different terms, right? So you can
Okay.
either take 1 year term, 5 year term. There's also some that offer variable rate terms, but the interest rate is higher than your standard. So right now, as you guys know, we're seeing rates in the 1%. But when it comes to a reverse mortgage, we're seeing rates in the 4% range, 4 to 5.5%. Retired parents right now, their income stream is already low, right? There's only so much that you get from CPP OAS, and if you have children that need that extra help in getting into the home ownership market, and they just need that extra down payment, this is a great way to help them out. The maximum loan to value is usually between like 50 to 55% loan to value, right? And the reason why that is we have a life expectancy, right? So that's why the older you are, the more money you get, because they know you're not going to be holding on to that loan very long. It's either you're going to be moving out to a senior's home, or like I said, the inevitable happens. You go into a big bank and say, hey, I want a reverse mortgage. They'll be like, we don't do that. So right now in Canada, there's only two providers. So one of them is Home Equity Bank. And again, you need to be in touch with a broker in order to access it. And same thing with Equitable Bank. So Equitable Bank also has a reverse mortgage. Word on the street is that there's going to be some more lenders that are going to be introducing projects that are very similar to reverse mortgages. Part of the reverse mortgage is actually most of the grandparents giving out their grandson, granddaughter money, generational wealth and inheritance. It's a common thing that they do see. And if you have parents that have equity, let them know that because maybe their income may be lower because they're retired or whatnot, there's still financing options. Because I know usually clients will go into their bank and be like, hey, I want to get out a line of credit, or I want to do a refinance to, help my kids out to buy their home or whatever the case may be. And most of the time, the banks have their criterias, right? They need to make sure that you have enough income to qualify for this equity takeout, is what we call it. And sometimes if you don't, just don't give up, don't get discouraged. Look into the reverse mortgage option. Yes, it sounds kind of weird where the interest rate is higher and you pay that stuff after, like behind the scenes at the end of the day. But if it's an opportunity to kind of help out your kids and maintain your lifestyle, because again, there is no monthly obligation, right? One of the biggest myths that we hear all the time is, oh, if I take this money out, that I'm not going to get that much for CPP or OAS. The government's going to think I make too much money and they'll cut back all my benefits. Absolutely not true at all. So if you need it, take it, right? That's the one thing. But if you're just taking it just to do nothing with it, I don't recommend it, because remember, you may not be making a payment on it, but again, there's still interest that's accrued, right? You're gonna have
Yeah.
to pay it somewhere somehow. You have to have a good exit strategy, and in order to do that, like, you got to work very closely with your mortgage broker, mortgage professional, just to ensure that there is an exit, right? You can't. The last thing you want to do is be stuck in there. So work with a trusted professional, right? And you have to ask them all the questions about, like, different strategies to getting out, right? And just making sure that there is a valid strategy in getting out, and making sure that's feasible, right? People can promise you the stars and the moon, but again, make sure you get your facts straight. Like, you gotta grill them, and you gotta make sure there is a pure exit.
Hey, look, we really appreciate you taking the time to join us and share the info.
Perfect. Thanks, guys. Thanks for having me.
Thank you, Kim.